Commodities have been rallying now for quite some time. We've got copper, gold, and silver all up between 15 and 30% this year, and that's pushing the Goldman Sachs Commodity Index up just about 8% year to date. So what does all this mean in the Fed's fight to tame inflation, and how are this rise in the commodities really threatening some improvement? We want to bring in Max Kettner. He is HSBC multi-asset strategist, here to talk about that and a lot more. Max, talk to me. The massive run-up that we've seen in a number of precious metals specifically, when you take a look at the run-up in gold hitting multiple records, when you take a look at the massive run-up that we've seen in copper, how are you factoring that into whether or not this is really reigniting some of those inflationary concerns?
Yeah, I don't think it reignites a lot of those inflation concerns, certainly not in gold. When we look at gold, I think a lot of that has been related to central bank buying. A lot of that has been related to this diversifying of central bank reserves. But it's also been really led by a little bit of a lack of diversification of bonds and of fixed income. Let's remember, particularly in the last 2 years, since the Fed has been embarking on this rate hiking cycle, that actually, most of the risk assets have been moving really with bonds. So bonds overall, rates really are no longer fulfilling that diversification property. And a lot of that was pushing gold higher. So I don't think that has an awful lot to do with inflation. Copper, on the other hand, you could be arguing that may be due to stronger demand, for example. But again, I think there is special factors in play here. When we look at the Red Sea disruptions, look at, for example, the throughput of copper through the Suez Canal that has really plummeted in recent months. So it's really much more led by supply disruptions, which at the end of the day should be proving more temporary rather than a proper pickup and a proper cyclical pickup in demand. So again, I wouldn't be too worried about it, particularly also when we look at copper. A lot of that has been reportedly driven by CTAs. A lot of that has been driven by momentum players rather than really by an underlying sort of fundamental shift.
But Max, as you mentioned, it's kind of the breadth of these commodity price spikes that we're looking at. It's the highest in 2 years. I do want to specifically get your take on what we're seeing with natural gas, specifically surging in the last month in terms of July contracts, having a 30% trough to peak rally before rolling over a little bit the past couple of days here. Does that specific move that we're seeing in the gas space start to lead to some concern about the outlook moving forward for you?
I don't think quite yet, because on the other hand, we've obviously seen oil prices down. So when we look at natural gas prices, yes, they've sort of moved really in opposite direction of oil prices. At the start of the year, when energy or oil prices specifically were going up, we've actually seen a bit of weakness in natural gas, and now it's the opposite. I would be more concerned if both really rise in tandem, if we get oil prices up, 30, 40%, if it pushes towards $100, and then on a year-over-year comparison, we compare sort of oil prices of 100 with 70 last year, and then, that brings natural gas prices up as well, then I think that would be more concerning. But really what we're seeing so far is that energy prices in the US are still relatively tame when we look at CPI energy, so the energy inflation basket. And in fact, when we look at other categories, say, for example, CPI goods, so goods inflation overall is still in disinflationary territory. So overall, not really something that I'm overly worried about. But I think what it does show, and that is absolutely clear, is that we're nowhere near 2% inflation. We're nowhere near hitting that 2% inflation target anytime soon. Not in the next certainly not in the next sort of 3 to 6 months.
So Max, what does all this then tell us about the broader market here? Because here we are, at least in the U.S., we're not too far from those record highs, at record highs in some cases. When you take a look, there's been talk of some frothiness that has maybe been showing signs, especially when you look at a few particular names. But do you think overall, despite the fact that we are at these elevated levels, is the momentum to the upside, and do we have further to run?
The momentum, I think, is clearly to the upside. Still, when we look actually at the frothiness, our shorter-term sentiment and positioning indicators do not even flash a mild sell signal yet. So we are seeing some pockets of sentiment and positioning that may be a bit frothy and that may be a bit stretched. But on aggregate, it's not even giving us a bit of a mild signal. We're not even at that point yet. That's number one. Number two is what we're seeing, for example, today. Look at the last couple of minutes. We see futures gains and equities erase. Why? It's because yields have popped, and they're popping in a fashion where it's particularly bond volatility, again, really rising very sharply. So to me, it's not really the inflation side. It's not really higher bond yields. It's certainly not the level of yields. I don't really care whether the 10-year is going to be at 4.5, 3.5, or 5, as long as that is matched up by very strong growth. The concern is if inflation turns to the ugly kind of inflation, if it's, again, just supply chain issues, if it's a labor mismatch, if it's wages strongly rising and, leading to concerns about corporate margins. So that would be a concern for corporate profitability again. And the other thing where I would be much more worried is if bond volatility once again really rises very sharply. So rather than the level of yield, it's the speed of the move, it's the rate of change that is much more crucial, I think, in the bond market for the overall risk asset spectrum.
Well, Max, I know your inflation measures and models that you look at are much more complex than what I'm about to say here, but I've got Target, Starbucks, McDonald's, Wendy's. I could keep going down the laundry list of companies that have touted the idea of a consumer that is really starting to struggle here, and we're seeing price cuts in relation to that. Does that make you worried that your call that inflation isn't defeated yet might be off?
No, not quite yet, because you can see other parts of the consumer that are still quite strong. And overall, what we're actually seeing is when we look at things like, for example, credit card delinquencies, one of those variables that a lot of people are looking at in order to show the strength of the consumer waning a little bit. Actually, when we look at things like delinquencies, they're still miles off where we were on average before the financial crisis. So still relatively healthy. That ultimately, actually, the consumer will be starting to feel some of those strains. That is, I think that is very clear. If yields really do not go down, if the 10-year yield is going to be stuck at 4.5 to 5, if the 2-year yield is not really going to move, if the Fed doesn't cut rates very aggressively, if they're only going to cut maybe 2-3 times in the next year and a half, 2 years, then it's very clear that at some point, perhaps in the next 2 years, the consumer and the economy overall will be really feeling the strain. The problem, of course, from a market perspective is that doesn't help us. We need to attach a timing angle to that. And I think right now, particularly what we're seeing in these pockets of weakness, we don't quite see them yet. So I don't think we're at that point quite yet.
Well, Max, just ending in our final minute here, your measure of real money investor sentiment hasn't moved towards a more extreme risk on positioning, and the market just feels very meh to me right now, really skeptical, even with the double-digit record highs that we've seen year to date. Why is that?
Yeah, I think I'm not sure if that was the technical term, but I would probably use it as well. It's a pretty meh market, right? Because at the end of the day, we're always discussing about, is it going to be 2 rate cuts? Is it 3? Is it 1? Are they going to cut in June or in September? Well, for risk assets, if we're really honest, it doesn't really matter. What really matters is if the Fed is going to hike again. If they're absolutely making a 180-degree turn and saying, actually, the next move is going to be a hike. If that doesn't happen, and that's been really now pretty firmly taken off the table, if that doesn't happen, then it doesn't really matter whether they're going to go in June or in September and December, because at the end of the day, we've always got to remember, why are they doing that? They're doing it because it's demand-led inflation. It's because growth is so strong that inflation isn't going down. It's not the bad kind of inflation from 2020 to 2022, where it was supply-led. It's the good kind of inflation where it's growth-led. As long as that continues, that's still pretty good for risk assets.
All right, Max, we got to leave it there, but really appreciate you joining us. Always great to get your insights here. Thank you so much. That was Max Kettner joining us. He is HSBC's multi-asset strategist.